Yeah, it's been a busy quarter with all the cat activity. We've seen floods in Slovenia and China. We've seen hail storms in Italy. We had a hurricane that first made landfall in Mexico and then made landfall in California as a tropical storm. And of course, the Maui wildfires, along with the wildfires in Canada. Now, this is coming after a very busy, very active first half of the year where the insurance loss totaled up to 50 billion, which was above annual average, and again confirms the 5 to 7% per annum trend that we have seen as far as the growth of insured losses go. Now, if we talk about specifically the Maui wildfires and the loss estimates, it's still early days to put a number, an industry loss number around it. The claims adjuster are on the ground and getting their hands around this event. But what we do know is that more than 3,000 structures have been damaged. And as far as the insured loss go, it is expected to be comparable to Hurricane Iniki, which is the costliest disaster in the history of the state of Hawaii. And lastly, and more importantly, this tragic event is another reminder of the extreme weather patterns that we are experiencing globally. What we are seeing is a larger proportion, a larger contribution to the total insured losses coming from secondary perils. In the last 30 years, we have seen more than 50% of insured losses come from secondary perils. If we look at the first half of the year, of the 50 billion insured losses, 70% have come from the US severe convective storm. So what we are seeing is unusual events are becoming more usual, and that's being driven by the extreme climate patterns combined with urbanization and exposure growth and the higher property values. And this pattern has become even more pronounced since the pandemic because the high inflationary environment is driving the cost of reconstruction to be significantly higher. So our industry has proven to be very resilient and innovative, and Swiss Re and its partners are investing a lot in understanding and quantifying the risk. The good news in this growing risk landscape is that the industry has strong and robust risk models for all perils, in particular for peak or primary perils. As the recent years have shown, there is a surprise loss potential both from frequency as well as from severity from these less well-monitored secondary perils. And it's critical that the industry continues to focus and invest in modeling and monitoring of these events and provide data transparency across the entire value chain. Now, the other thing is that fundamentally, primary insurance companies are better suited to absorb attritional and frequency losses, while the reinsurers play the role of a shock absorber for severity type events like the Turkey earthquake this year. In 2023, we have seen a shift towards more balanced risk sharing across the value chain, and this is a necessary path that we expect to continue.